So today we are going to go over SMAs, EMAs, what they are, how people calculate them, but how more importantly I trade them according to my strategy. Okay, so first of all, what is an SMA and an EMA? You guys hear and see okay? Everything good? Also, if you guys have any questions, there is a chat room in here. Cool. Okay. Oh, good. So SMA stands for simple moving average. EMA stands for exponential. I probably gonna spell this wrong. I think I spelled it wrong. Anyway, so simple moving average, exponential moving average. First, let's go over simple because, well, they're easier to understand. Let me get my eraser. Okay, so a simple moving average, basically all it is it takes, someone give me a number, any time frame, 1 year, 6 months, 20 day, 30 day, throw a number out there. 6 months. Okay, so the 180 day SMA just takes the last 6 months or last 180 days of data. It takes the closing price of the stock. For example, if on average, if you add up all the days on a $10 stock, and one day closed at 9, one day closed at 10, one day closed at 11, so you add that all up, and it averages all 180 days. It averages 1,800. Okay, so basically, on average, over 180 equals $10. So basically, all SMA is, it takes the last 180 days, or whatever time frame you use. It counts up all the days, the closing price, finds the average, the mean, and that's where the SMA is. So, for example, if a chart looks like this, okay, if a chart looks like this, we have 6 months of data in the candlesticks, doing this. All the SMA is doing is it's taking the average and trying to be as simple as possible. And why? That's the SMA. And why do traders love using these? Well, it gives them an easier point of contact, point of reference. Basically, it takes the overall average of the move. So traders are less emotional. In case there is, a pullback, they want to make sure the overall trend, the SMA is going up. That's why I don't like using, or that's why I use the SMAs and the EMAs on the 180-day time frame and the 1 year time frame to see where it's at. If the overall trend's moving down, which 99% of the stocks are trading are indeed moving down, if it taps that, generally gets rejected. The 200, the 180-day. That's what I use. Okay, so now moving on is does everyone get what an SMA is? Does anyone not understand the SMA? I don't want to move on to the EMA if people don't understand the SMA. Do a thumbs up or a yep or anything like that. You got one thumbs. Sully Man got it. Julian got it. Frankie. Okay, so does anyone not get it? I think it's okay. If you don't get it, I will go back through. I think just about all you got it. You don't get it 100%. Okay, let me go through it one more time, and I'll actually show you a real example. So let's do hypothetically the 10-day SMA. Okay, so we have 10 days of data. This is a stock chart, and the first day you closed at $10. Next day 11, and then 9, 10, 11. It kept doing this chart. 11 was a big resistance, 9 was a big support. It keeps doing all that. So one day last week closed at 10, they closed at 11, then falls, closed at 9. You see the average. Then basically all the SMA is doing is it's trying to find the average of what it's closing at, and then it creates this line or the simple moving average. Likewise, if it was closing at 10, 9, 8, 7, the SMA would be looking like this on the chart. It would be going down. Okay, so basically the simple moving average is all it's doing is it's finding the mean of what the stock price is doing in that given time frame and creating a line. That's all it's doing. I'll go back in and I'll show you real life examples. Now, the exponential moving average is a little different, and I like it a little bit better. Now, the reason why I like the EMA and I use the EMA for day trading is because more active traders actually use the EMA. Now, does anyone know the difference between the EMA and the SMA? There's just one key difference. That's it. One key difference. Does anyone know? Anyone want to stab at it? Free t-shirt for anyone who knows. Oh, that was the pressure on. Give you guys 2 minutes. One is exponential, more accurate. EMA is faster. Close. What do you mean by faster? You're onto something. More weighted. Okay. On what? Dubon, what is exponential more average more weighted on? Yeah, on price, but what type of price? Data that's current. Yep, you got it, Julian. So it is more heavily relied on the more current data. Okay. So Julian, DM me after this, we'll give you a free tea. You guys all did very well, but technically Julian got it first. So here's a chart. Okay. The exponential moving average, all it does the same exact thing. But in this case, say we have 180 days of trading data. Okay. The exponential moving average, let me use more colors here so you guys can clearly identify the difference. I'll make this bigger. I'll make this bigger. Plus DRP just landed, so I want him to hear this. Here we go. So we have the 180-day time frame, and the stock chart is kind of doing this, consolidating, and then within the last 10 days, it just, that might be a little exaggerated. Let me adjust that a little bit. Positive catalyst, positive earnings starts taking off. Okay. So the SMA in this normal circumstance, it would just take the average, but this amount of data would weigh just as much as this data. And that's not quite fair because this data is just consolidating. Something new might have happened in this stock's performance. And the reason why I like the EMA is it weighs heavier on more recent days. It still keeps this data in place, but it weighs a little bit more heavier on recent days. The reason I like that is because it catches on to trends quicker. Okay, so the SMA, I need more colored markers. The SMA would probably do this. Okay, pretty far away from it. That's the SMA. Now the EMA would be doing the same thing, but then when it starts to take off, it weighs that data a little bit more heavily. So it can identify a trend easier. Okay, that's the only difference. Is it just weighs on the data a little bit heavier. Now there's an algorithm for this and a calculation. I'm not going to bore you guys with that today. Thomas Dabs can't hear. Can anyone not hear besides T-Dabs? All you have to do, T-Dabs. Oh, he can't hear me, so I'm not going to try to explain it to him. But does anyone not get the reason why I like the EMA more? So the reason why this is so handy is because clearly sometimes a stock can change just like that. For example, GNS or GENE this morning. I'll show you it real time. It had a direct offering and it plummeted, literally plummeted. An offering changed the whole outcome of the stock's price action. It literally went like this. You know, was trading, and then dumped. Now the SMA would still be doing probably this. It would slowly start going down. That's not going to help me. I can tell that the price is going to go down, and in order for the candle to get back up to, or the stock to get back up to SMA, I need to have a wild rally. While the EMA comes in and says, "Hey, you know, stock, or hey trader, you know, a lot happened as of recently. I'm going to now weigh this more heavily, and I'm going to show a closer trend line." That's why I like the EMA a lot more. Now, a lot of traders can use these in conjunction with each other. You can see a lot of traders, they will I personally don't do this, but I think some options traders might. They use like a 10 SMA or 20 EMA, and when they cross each other, like this, that, and then the EMA is like that, and then they'll buy right there. I think it's kind of dumb. I understand what they're doing, but personally, as a momentum trader, that doesn't help me at all. Okay. Now, before I move on, does anyone not understand the EMA, the SMA, or why I use them or how I calculate them? Does anyone not? I will go over this 100% again if I need to. However, I will show it to you guys in a real life example. Now, while you guys are asking your questions, I'm going to show you guys how I trade them. Okay, paystack takes off, first wave consolidates, takes off, second wave consolidates, pulls on back, something like that. What we see often is the exponential moving average deems an excellent support line. So what happens is it obviously starts behind it and it catches up, does something like this. Now, because it's exponential and what we know about exponential charts, it's like that, it weighs this data a lot more heavier. So on dip buys or support buys, you often see me buying when the penny stock comes into contact with the 9 EMA. Okay, 9 EMA is great. And every time it taps that 9 EMA, you saw me do this morning. You saw this exact thing happen this morning, and I bought. Now I'll show you the example. This was on the 1 minute time frame, and the stock was. Let me think. Can we actually go to it? I can draw it out. The EMA was just catching up to the penny stock because the penny stock was rallying. I mean, this is the penny stock. Penny stock was doing this. And the second it flashed down, it bounced off that 9 EMA. I bought off that support line, and it rallied. Very common for the 9 EMA to act as a solid support line. I'm going to show you some real life examples. Now, you can use the 9 EMA for the long or the short side. People don't understand this. People don't realize that you can use this. It's a double-edged sword, okay? I'll show one more example, then I'm going to go in the actual my actual trade logs here. Last drawing example. I'm sorry. Okay. Pay stock rips. First pullback, second pullback, third pullback tries. Reversal. Now, hypothetically, if the 9 EMA is doing this, hitching up to it, okay, and then you see that. Where do I start my short? Okay, when it breaks below, it actually closes with a 1 minute or a 5 minute candle. You generally the 5 minute candle when it closes below the 9 EMA. That's complete confirmation that this is no longer the trend. Again, the exponential moving average and the simple moving average are solely to identify trends. That's all they're doing. And if the 9 EMA is doing this, that's a very bullish trend. Now, if it breaks that trend, that's an awesome short opportunity, especially if you count your pullbacks and you hear 1, 2, 3. Okay, that break is a solid play. So you can use this exponential moving average to identify support, like here, right here, or when it's going to either come as a kind of a break point. Now, if it breaks below this, it's time to short. Now, just note that yes, sometimes you can see a penny stock flash below it. Traders buy the dip and then it rallies. Flash below it, buys the dip and rallies. That's why I wait for a 5 minute candle to close below the 9 EMA and then I start my short. Okay, because that's all it's doing is identifying trends. And when the trend changes, you don't want to be long anymore. You want to be short. All it does. So let's go in my computer and let's look at some real life examples. And if it still doesn't make sense, I will come back and I'll redo this again. Okay. Now allow me to share my screen. Share the screen. Boom. Okay. Clear drawing set. This is HSCS on the 1 minute time frame. Let me get rid of VWAP so you only see the 9 EMA. So the 9 EMA is this blue, the cyan blue line. Okay. Now, the first trade I took on it was the first dip it had on said 9 EMA. For example, right here at 9:10, it rallied. The 9 EMA caught up to it. What happened was the stock had a nice pullback, bounced off that 9 EMA. I bought off that 9 EMA bounce, and I sold as a pop tire. And as you can see, it held it for a few more times. And then it continued to trade out. But I like the 9 EMA more so on the 5 minute time frame. I'll show you a good example if it'll let me scroll back here. Great example right here. This is a 9 EMA on the 5 minute time frame. Okay, for example, boom, it news popped, pulled on back, found support in the 9 EMA, rallied. Pulled on back, found support in the 9 EMA, rallied. Pulled on back, found support in the 9 EMA. Then I did actually take this short opportunity as it broke below it, but there was another key news catalyst kind of threw this off, and it ended up rallying even more so. Excuse me. But you can often see if it closes below this 9 EMA, it's a very bearish indication, especially right here as it got halted going down, resumed lower, traded much lower. Is there any other examples I can show you? I have hundreds of examples. I'm just trying to think of one that we've traded as of recently. Let me see. Scroll. BGXX. I was screaming at some of the team members, not screaming, but quite literally screaming at some of the team members to short BGXX. Look at this. It validated the 9 EMA the entire ride to the upside, not the body closing below the 9 EMA once. Literally not once. It continued and continued to rally. Okay, bouncing. Solid support buys all the way up. And then when it had a candle close below it, look what happened. From 170 all the way down to 140. And I took this short and I cashed on it. That is how to use the 9 EMA. Use it as support for the first 3 pullbacks. And then when it stops validating it and actually breaks below it, time to reverse your order, go short, lock in profits. It's probably going down. Okay. I don't think it's going to let me view the chat. Maybe chat. Okay. I got the chat pulled up. That's practically it, guys. That's the exponential moving average. Now I could show you what it looks like on the daily time frame. But this is the 9 EMA on the daily time frame. Doesn't work out that well. Now the 9 EMA can work out for a lot of time frames. You see me use that on the 180-day time frame. You see me use it on a lot of time frames. But on things like the daily, the 9 EMA is going to be obsolete. No traders using the 9 EMA on the daily time frame. They're just not. So you need something that isn't as exponential. It's more forgiving on the daily time frame. Which is in my experience, I like using the 200 EMA. Go to exponential, add, bada bing, change this to 200. It was default. Okay, now it's taking every 200 points of data and creating this consolidation line. HSCS. Let me see if we can pull up an example. That's not a terrible one. I'm just trying to think of stocks I've traded in the past. Okay, right here. I honestly would not have wanted to trade it right here because the 200 MA was perfectly coming into contact with GNS. And as you can see, every time it tapped the 200 MA, it wicked down and created a good short opportunity. A lot of traders would not have traded this. In fact, today I wouldn't have traded it because it was trading above the 200 MA. So that's a key indication that either the move is done, it's time to lock in profits. Down here, if it's below it, that's fine. But if it's like 604 and the 90 MA or the 200 MA is at 626, I would not be trading GNS because it's more than likely going to get rejected by it and confirm a reversal. Okay. Now, Does anyone have any examples? I could go over the SMA, but quite honest, I only use the SMA for SPY, really. That's about it. But as you can see, when SPY was rallying over the years, it continued to hold this 200 MA. Look at how many times it bounced off the 200 MA. And then what ended up happening was when it dumped, I can zoom in here, broke below it, retested it, got rejected, dumped. I'm not saying COVID happened because it broke below the 200 MA, but you can see that 200 MA is often a very good support and or resistance line. So right now, I would be bullish on SPY. Why? You can see the 90 EMA, or sorry, 200 EMA start to curl back up, start to confirm a reversal. It's now holding above the 200 EMA. Got rejected by it, broke below it, retested it, got rejected, then retested and broke, and now it's starting to rally. I would be bullish on SPY. I would. That's how I use the 200 EMA. Now, is there any questions on how I use it, on how to calculate it, on why I use it? Again, my favorite pair is using the 9 EMA on the 5-minute time frame. That is my absolute favorite. BGXX is a perfect example of how to use it. And that's really that in the VWAP are the only catalysts I use. And I'm going to teach you guys the VWAP when I get back from vacation. What do you think, guys? Yay, nay, you want me to redo it, go over it? Good lesson, bad lesson, went over it. Sully gets it. And if you don't understand it, that is fine. It took me a long time to understand some of these things. That's what I'm here for. Speak now or forever hold your peace. Any questions you have? Any questions? Dubon gets it. Julian got it. Good lesson to watch for the next live stream. Frankie got it. Yeah, it's hard to kind of comprehend it when we're just talking about it. You know what? I have the trade on. You want to see something cool? I got the trade on video. Watch this. So this is the 90 EMA. Look at the top left hand chart. It's on the 1 minute time frame. Okay, watch what happens. So it's currently dumping, but my charts are kind of bugged. Right there. So, okay, so it's retesting that 9 EMA, okay, on the 1 minute time frame. And I have it muted, but I say I'm buying here. So I bought right there off the retest, and then look at this 5 minute this 1 minute candle turn green. I'm zooming in on it. Buy volume steps in. Good pump. I sell right there at 255. Okay. So you can see the 9 EMA often acts as a solid support line on the 1 minute as well as the 5 minute. I like the 5 minute for shorting, and the 1 minute for dip buys. That's just how I play it. Okay, that's a live example of how the 9 EMA is used. Does anyone not understand why I traded that trade? Again, I like exponential more than simple because if I was a swing trader, I would probably use simple more. But as a day trader, simple does not help me because a penny stock can change like with a snap of the fingers. And all of a sudden the simple is still tracking last week's data. And the next thing you know, it's skyrocketing and it's trying to weigh last week's data where there was no catalyst compared to now. It doesn't make sense. So you have to use exponential because it's going to weigh the prior data more and the prior volume more.